On November 26, 2025, something embarrassing happened to Rachel Reeves. 2 hours before Britain's Chancellor was due to deliver her make-or-break budget to Parliament, the Office for Budget Responsibility, the independent fiscal watchdog, accidentally published its entire economic forecast online. Every number, every projection, every damning detail. The GDP growth forecast, downgraded. Productivity growth, slashed. The fiscal repair job required, larger than expected. Reeves stood at the dispatch box in the House of Commons and called it deeply disappointing and a serious error. But the damage was done. The narrative was set before she'd said a word. This was Britain's second Labour budget in just over a year, and it revealed an uncomfortable truth. Despite £66 billion in combined tax rises across the budgets, the largest sustained tax increase in modern British history, the UK economy remains trapped in a doom loop of weak growth, rising debt, and impossible choices. 13 months into Labour's government, Rachel Reeves has delivered more tax rises than any Chancellor since the Second World War. The tax burden will hit an all-time high of 38% of GDP by 2030. And yet, living standards are forecast to grow slower than expected. Business confidence is fleeing. So the question isn't whether Reeves raised taxes, it's whether those taxes will actually fix anything, or whether Britain is simply postponing an inevitable reckoning. Today, we're going to examine what Rachel Reeves actually did. We'll trace the economics behind the decisions. We'll explore what the independent forecasters are really saying, and we'll answer the fundamental question: has this budget saved the UK economy or doomed it? To understand where we are, we need to understand where we started. When Labour won the July 2024 election, they inherited what Reeves called a £22 billion black hole in the public finances and funded spending commitments from the previous Conservative government. Public debt stood at 98.5% of GDP, the highest since the early 1960s. Public services were crumbling. The NHS had waiting lists in the millions. Infrastructure was decaying. And Labour had tied its own hands. During the campaign, they promised not to raise income tax, employee national insurance, or VAT, the three big revenue raisers that fund most government activity. They'd also committed to strict fiscal rules, balance day-to-day spending by 2029 to 30, and get debt falling as a share of the economy. These promises created what economists call an impossible trilemma. Fix public services, don't raise taxes on working people, reduce borrowing. In October 2024, Reeves delivered her first budget. It was extraordinary. £40 billion in annual tax rises, the largest single-year tax increase since records began. The centrepiece was a £25 billion raid on employers' national insurance, raising the rate from 13.8% to 15% and lowering the threshold at which employers start paying. There were capital gains tax increases, inheritance tax changes affecting agricultural and business property relief, the abolition of non-dom tax status, an extension of the energy profits levy, VAT on private school fees, and critically, a freeze on income tax thresholds, extended through 2028, a stealth tax that would drag millions into higher brackets through fiscal drag. The Office for Budget Responsibility projected these measures would raise £36.2 billion annually on average, reaching £41.5 billion by decade's end. In return, Reeves promised £22.6 billion more for the NHS. Defence spending would rise by £2.9 billion. There would be £5 billion for housing, investment in infrastructure, education, and public services. And crucially, Reeves changed the fiscal rules themselves. Instead of targeting public sector net debt, she targeted public sector net financial liabilities, a measure that accounts for the value of assets created by government investment, not just the cost of borrowing. This freed up £53 billion for capital spending over 5 years. Borrowing for investment, she argued, would drive long-term growth. The market reaction was mixed. Initially positive, the government was taking fiscal responsibility seriously, but bond yields began rising. borrowing costs increased, and the OBR's growth forecast revealed an uncomfortable truth. Short-term GDP boost, yes. Medium-term growth improvement, negligible. The OBR projected UK real GDP growth of 2% in 2025, then falling to 1.8%, 1.5%, and 1.5% in subsequent years. Budget policies would deliver a temporary boost to GDP in the near term and some crowding out of private activity in the medium term. In other words, the spending would provide a sugar rush, but long-term economic capacity unchanged. Then came the real problem. By March 2025, that carefully constructed fiscal plan was already unraveling. Reeves had built just £9.9 billion of headroom against her fiscal rules. That's the buffer before she'd breach her own borrowing limits. For context, the OBR's average forecast revision between updates is £21 billion. One bad forecast, and the entire plan collapses. And that's exactly what happened. Fast forward to November 2025. Rachel Reeves stood up to deliver her second budget, and before she'd said a word, the OBR had already revealed the bad news. Productivity growth forecast downgraded from 1.3% annually to 1%. That's a massive revision. Lower productivity means slower economic growth. Slower growth means lower tax revenues. Lower revenues mean higher borrowing or more tax rises. The fiscal mathematics were brutal. Before accounting for any new policies, the OBR calculated that Reeves would have just a £4 billion current budget surplus in 2029 to 30. Her previous £9.9 billion headroom had evaporated. The £22 billion black hole from the previous government was back only this time. It was Labour's own policies creating the pressure. Why? Several factors. First, the productivity downgrade reduced forecast GDP by £16 billion. Second, welfare spending was higher. The government had reversed planned cuts to disability benefit savings that were baked into the previous forecast. Winter fuel payment means testing was relaxed. Special educational needs spending was soaring, forecast to grow 14% in real terms in a single year, creating a £6 billion gap by 2028 to 29. Third, inflation was running hotter than expected, 3.6% in October 2025, well above the Bank of England's 2% target. That pushed up benefit payments and debt interest costs. The good news: wage growth was also stronger, generating higher income tax and national insurance receipts. The shift in economic activity toward more heavily taxed sectors also helped, but it wasn't enough. Reeves faced a choice: cut spending, increase borrowing, or raise more taxes. She chose taxes. Again. The November 2025 budget raised £26.1 billion annually by 2030. Not as large as the first budget, but still massive, making this the highest taxing Labour government since records began. The biggest single measure was extending the income tax and national insurance threshold freeze for another 3 years to 2030 to 31. This alone would raise £7.6 billion in 2029 to 30, climbing to £13 billion by 2030-31. Through fiscal drag, 780,000 more people would be pulled into paying basic rate tax for the first time, 920,000 into higher rate brackets, and 4,000 into the additional rate. Then came the salary sacrifice cap. Currently, workers can sacrifice unlimited salary into pensions, avoiding national insurance on those contributions. From April 2029, that relief would be capped at £2,000 annually. Anything above pays full national insurance, adding costs for both employees and employers. There was a mansion tax, revaluing council tax bands F, G, and H4 properties worth over £2 million, potentially adding thousands to annual bills. Cash ISA limits were cut from £20,000 to £12,000 for under 65s, pushing savers toward stock market investments. Dividend tax rates increased by 2 percentage points, Property and capital gains tax rates rose. The two-child benefit cap limiting tax credits to the first children was scrapped from April 2026, a welfare expansion costing billions. In total, taxes would rise to 38% of GDP by 2030 to 31, an all-time high. In return, Reeves promised £22 billion in fiscal headroom by 2029 to 30, more than double her previous buffer. Borrowing would fall from £138.3 billion in 2025 to 26 to £67.2 billion by 2031. The budget deficit would move to surplus by 2028. But there's a problem, a big one. The promised fiscal consolidation is backloaded, heavily backloaded. Look at the borrowing profile. In each of the next 3 years, 2025 to 26, 2026 to 27, 2027 to 28, borrowing will be higher than previously planned. The spending is happening now. The tax rises, most don't take full effect until 2028 or later. Some, like the salary sacrifice cap, don't start until the spending restraint Reeves is relying on to balance the books. That comes in 2029 to 30, right before the next general election. The Institute for Fiscal Studies was blunt. It's one thing to promise a reduction in borrowing, and another to actually deliver it. Between 2028 to 29 and 2029 to 30, Reeves has penciled in zero real terms growth in departmental spending. Not slow growth. After years of increases, spending suddenly flatlines, just as Labour faces voters. History suggests this won't happen. No Chancellor delivers painful spending restraints in an election year. The political incentives point in exactly the opposite direction, which means one of two things occurs. Either Reeves breaks her fiscal rules when 2029 arrives, borrowing more than promised, or she comes back for a third round of tax rises to plug the gap. The markets are skeptical. UK government borrowing costs are the highest among G7 nations. The 30-year gilt yield has spent much of 2025 above 5% levels, not seen in decades. Bond investors aren't convinced the fiscal arithmetic adds up. Businesses are even more worried. The double hit of higher employer national insurance and rising minimum wages has hammered margins. The British Chambers of Commerce warned that retail, hospitality, and construction sectors face an extinction-level event. One analysis suggested the typical hospitality business would see costs rise by £25,000 annually, impossible to absorb without cutting staff or closing locations. Black Country Chamber of Commerce, representing 750 businesses, said it was hard to see how the budget would drive growth. The salary sacrifice changes would increase employer costs. The minimum wage rise, welcome for workers, adds pressure when there's no growth to pay for it. The mansion tax could further slow the housing market, hitting construction. Sarah Morehouse, the Chamber's CEO, summarized, businesses will be breathing a sigh of relief that they weren't a marked target for tax hikes like last year, but a number of measures announced will simply add to the crippling cost pressures that many face on a daily basis. And then there's the productivity problem. The OBR's downgrade from 1.3% to 1% annual productivity growth is devastating for long-term prosperity. Since the 2008 financial crisis, UK productivity has been abysmal, the worst performance since the Industrial Revolution. The OBR has been persistently over-optimistic, forecasting productivity improvements that never materialize. The 1% forecast is probably more realistic, but it also means Britain's economic speed limit is lower than anyone hoped. Lower productivity means lower GDP. Lower GDP means lower tax revenues. Lower revenues mean the fiscal math doesn't work, unless something changes fundamentally, and nothing in this budget suggests it will. Britain is trapped in a low, high tax, high debt equilibrium. But perhaps the most damning verdict came from the OBR's household income forecast. Real household disposable income, the actual purchasing power families have after taxes and inflation, will grow more slowly than previously expected. The income tax threshold freeze is the main culprit. increasing the tax burden on households as wages rise. The Resolution Foundation calculated that, if this forecast is realized, the 2024 to 29 Parliament would be the second worst on record, for income growth beaten only by the pandemic-disrupted 2019 to 24 Parliament. Think about that. The Labour government, elected to improve living standards and restore hope, is presiding over one of the worst periods for household income growth in British history. Yes, there are short-term cost of living measures. Energy bills will fall by £130 for a typical household. Fuel duty is frozen until August 2026. Draft beer duty is cut by 1.7%. The state pension will rise by £575 under the triple lock. But these are temporary. After 2026, the energy bill support expires. Fuel duty will begin rising. The bulk of the tax increases, the threshold freezes, the salary sacrifice cap, the higher dividend and property taxes are permanent. And for the wealthy, the mansion tax, reduced ISA limits, higher capital gains tax, inheritance tax changes, these are significant. But they're not enough to offset the broader hit to middle-class households. The fiscal drag from frozen thresholds is particularly insidious. It's a stealth tax that compounds over time. Every year inflation rises, more people cross into higher brackets. By 2030 to 31, an additional 1.7 million people will be paying higher rate tax compared to 2024. The Chancellor acknowledged this, saying, "I know that maintaining these thresholds is a decision that will affect working people." But she did it anyway, extending a policy she'd previously criticized the Conservatives for implementing. It's a broken promise dressed up as fiscal responsibility. So, has Rachel Reeves' budget saved the UK economy or doomed it? The honest answer is neither. It's bought time. The £66 billion in combined tax rises across the budgets have stabilised the public finances for now. The £22 billion fiscal headroom provides a buffer against economic shocks. NHS funding has increased. Public investment is higher. Welfare cuts have been reversed. These are real achievements. Without action, Britain's fiscal position would have deteriorated rapidly. But the fundamental problems remain unsolved. Productivity growth is weak. Business investment is falling. Living standards are stagnating. The tax burden is at record highs. And it's still not enough to fund the public services people expect and eliminate the deficit. The budget doesn't create growth. It redistributes income from businesses and households to the state, funding higher public spending in the hope that investment in infrastructure and services will eventually boost productivity. Maybe it will, but the OBR's forecast suggests otherwise. Temporary boost, then reversion to trend. The real test comes in 2028 to 29. That's when the backloaded spending restraint is supposed to kick in. When the difficult choices deferred today can finally be made. When Labour will face voters and explain why, despite record tax rises, living standards didn't improve as promised. If growth surprises to the upside, if productivity finally recovers, if business investment rebounds, if wages rise faster than expected, then Reeves will look prescient. The painful tax rises will have secured Britain's fiscal future while protecting public services. But if growth disappoints, if productivity remains weak, if businesses cut investment in response to higher taxes, if fiscal drag continues crushing household incomes, then this budget will be remembered as the moment Labour chose to tax its way out of a crisis that required structural reform. The UK economy isn't saved, but it's not doomed either. It's simply treading water, spending more, taxing more, borrowing more, while hoping that somehow, someday, growth will return and validate all the sacrifices. That's not a plan. It's a gamble, and Britain is betting its future on it.